Welcome to this Killick Explains video, and welcome to 3 common recession indicators that I don't think investors should be too worried about, at least not yet. So you'll read a lot about these individually and together, but I think they need to be taken with a little bit of a pinch of salt, and I'll try and explain why as we go through the video. So, first of all, analysts like to try to forecast recessions, and the media certainly like to try and do so after a long period of calm, after a pandemic that then followed it, and of course the war, Russia invading Ukraine. People are looking for signs that things might be about to turn upside down. And 3 classics are the yield curve, more about that in a moment, the oil price, more about that in a moment, and consumer confidence. So let's take each of these in turn, explain the conventional analysis if you like, and then I want to give 1 or 2 pointers to suggest that investors shouldn't necessarily panic, certainly not when one of these starts flashing red just at the moment in 2022. So yield curves first of all. Now yield curves are built, for anyone who's not sure, on basically plotting the yield available on similar types of bonds, IOUs, typically government bonds with different maturities. So broadly speaking, short, medium and long dated. Now, the basic premise is this. If you were to put your money to work with the government in a particular type of bond for only 2 years, you might expect a relatively low return. On a similar type of bond for 10 years, that's lending your money to the government for 10 years, you'd expect a slightly higher return in terms of yield. And if you were to lend your money to the government over, say, 20 years, so the IOU is long dated, you'd expect to get a higher return still on an annual basis. So, as the graphic next to me and my arm's about to suggest, yield curves conventionally point upwards, as it's called. They slope this way because they reflect the fact that investors are rationally asking for a higher return for investing their money with the government over a longer period. Now that normal relationship, that upward sloping curve as it's called, basically can get challenged. You can get the yield curve flattening and you can even get it inverting like that. Now that can worry analysts because what they say is, why is that happening? And the answer can be investors are anticipating trouble. They're anticipating the fact that interest rates may have to be cut. Why would that be? That central banks fending off a recession, for example, by cutting rates, growth slowing. So the reason the yield curve inverts is suddenly investors are saying, yes, normally I'd want compensating for time risk, but I'm prepared to set that to one side and actually put my money to work over a longer term period to lock in a reasonably decent yield while I can, which puts basically pressure upwards on longer dated bond prices and pulls yields down and tips the curve like that. But although inversions have been a very reliable past indicator of recessions, actually the last few, if you look back over the last 5 years or so, have been much less reliable. So maybe that relationship between an inverting yield curve and an imminent recession is weakening. Why would that be? Well, the principal reason is central bank action. Central banks are gradually trying to row back on what's called quantitative easing. And quantitative easing was a huge program of buying bonds of all sorts of different ages or durations as they're known. And basically rowing back on that means bonds are increasingly, if you want to see it this way, being dumped in the market at random durations, at random points of redemption. And if you get a lot of bonds released, let's say around the 10-year mark, that's going to skew the yield curve, irrespective of the economic backdrop. So the optimist would say, maybe, nobody knows for sure, maybe that signal from the yield curve isn't as reliable as it used to be. Maybe there are technical factors that explain a short-term inversion. So there's one, perhaps we don't need to worry about as much as we used to. Number 2 is the price of oil. Again, anyone who lived through the 1970s, and admittedly you'd have to be mature in age for that to have happened, will remember a huge oil price spike one of the biggest we've seen in recent history, accompanied a crashing recession. So people watch the oil price spiking again for all kinds of reasons that my colleague Rachel has covered in her market update, to do with the market tightening up on the back of supply issues, the Ukraine situation and so on, and they say, crikey, there is a forward warning of a possible second recession. No, not necessarily. Why not? We're not as dependent on oil in heavy industrial terms as we used to be, to summarise a lot of arguments in one nutshell. Number two, renewables. There are many other sources of energy aside from oil. So number three, maybe we have a global economy that is a little bit more resilient to oil price shocks than it used to be. Now, I can't promise that, but that is the theory of optimists who say that actually an oil price spike doesn't necessarily mean looming and an imminent recession. And therefore, looking back to the 1970s as a kind of playbook as what's going to happen next isn't necessarily constructive. And number three, and there are many other indicators, this is one that's being published a lot recently, consumer confidence is on the wane, and that surely points to trouble. Well, the conventional argument is that yes, consumer confidence is vital to economies, it's vital to businesses, because if consumers don't borrow and spend, businesses won't invest, and therefore the economy will start to slow. And that is an established sort of relationship, if that makes sense. And then people say, and if you look at the recent Michigan survey from the all-important US economy, around a quarter of global GDP still generated by that economy, if you look at the recent Michigan survey, it plummeted 20% year on year to its worst reading in a decade. Yes, it did, but potentially cushioning that slowdown in consumer confidence, for all kinds of good reasons, if you like, but that slowdown in consumer confidence, we have savings levels through the pandemic, which people haven't spent those savings yet. Those are still there as a kind of cushion, if you like, those record savings levels. Household debt levels appear to be reasonably stable, certainly compared to sort of entry points into previous recessions, if you like, and other key indicators of activity, not just about consumers after all, are relatively stable as I make this video. What other measures, I hear you cry? PMIs, reasonably stable, and those are important. Those are purchasing manager indices, so indicators of what businesses are up to, if you like. The uncertainty index, do people have confidence in central banks' ability to manage our way out of here? Still reasonably stable. And the VIX, the equity market's fear gauge, built on what's happening in the options market. Won't say too much more about this, other videos on that topic. Reasonably stable. High, yes, but coming down from previously higher levels. So, my conclusion, yes, yield curve inversions, oil price spikes, and plunging consumer confidence have, sometimes in the past, been reasonably reliable indicators of a looming slowdown and recession. But, for the reasons I've mentioned, individually and even in aggregate, they may not be quite as reliable as they used to be, and as an investor, I certainly wouldn't be hitting the panic button on the back of any of those three readings. Now, if you'd like to know more about any of the terms I mentioned in this video, the VIX, the yield curve, all those good things, please do access my extensive library, killick.com/learn. And if you'd like a copy of some of these guides sitting next to me, one of them is called How to Invest in Equities, do ping me an email, editor@killick.com. And if you'd like the theory put into some kind of practical context, then do ping me an email, editor@killick.com, for a copy of the latest quarterly Confidant magazine.